Welcome to The Explainer, where we break down the big stories behind the numbers. Today, we're diving into the booming and really complex world of the Indian snacks and namkeen industry. And it's a fascinating story of incredible growth, but also some intense pressure on the bottom line.
Okay, so let's get right into it. To really understand what's happening, you first need to grasp the sheer scale of this market. I mean, the numbers are just staggering.
Just look at this. This is the projected size of the domestic snack market by 2033. Yep, that's over 1 lakh crore rupees. And it's not just big, it's growing at a blistering pace of over 8.5% a year. We're talking about an enormous consumer powerhouse here.
Now, this kind of explosive growth doesn't just happen in a vacuum, right? It's being fueled by these huge demographic and economic shifts all across India. You've got more money in people's pockets, busier lives that demand convenience, and a massive expansion of online shopping reaching into even smaller cities. But, and this is a big but, as the revenues keep climbing, a very different story is unfolding on the balance sheet.
So let's move on to the financials and see how this all builds up. Because this is where we find the real tension at the heart of this industry. It's kind of like that classic phrase, more money, more problems.
On the surface, things look great. You can see operating revenue has had this really steady growth. If we just set 2023 as our baseline, we're looking at a healthy 16% climb in just 3 years. So sales are up, and people are definitely buying.
But here's the twist. Look at the margins. They're all over the place, incredibly volatile. They swing from a negative 4% loss in 2023, pop up to a brief positive 2%, and then boom, right back down to a 4% loss. The point is, all that amazing revenue growth just isn't translating into stable profits.
So this is the crucial question, isn't it? With revenues going up, why are profits under so much pressure? Well, to answer that, you gotta follow the money. So let's break down the costs.
Now, what's really fascinating here is the overwhelming dominance of one single category, the cost of raw materials. You know, the potatoes, the flour, the spices, all of it. That makes up a staggering 84% of all expenses. Everything else, as you can see, is just a fraction in comparison. This one line item basically dictates the financial health of the entire industry.
And this table, wow, this really puts the challenge into perspective. So while companies have managed a slight improvement in their biggest expense, material costs, that gain is being completely wiped out somewhere else. Look at this. Selling expenses have more than tripled. That is the cost of competition, of having to shout louder to get noticed in a really crowded market. And on top of that, general expenses have nearly doubled. So they're spending more just to sell and run the business, and it's eating away at any profit they might have made. Okay, so how are companies fighting back in this high-growth but low-margin world? Well, they're getting strategic. So let's take a look at what some of the leaders in the space are actually saying, and more importantly, what they're doing about it. Right here, we have Sita Industries, and their management's own words are a direct response to those cost pressures we just saw. Just listen to the language they use. Rationalize trade margins, optimize channel economics, disciplined cost control. This is the vocabulary of a company that is laser-focused on efficiency and profitability. In a market this tough, you could say they're playing defense. You can see their strategy is built on 3 really clear pillars. First, consistent but not explosive growth. Second, a laser focus on profitability. They want to see over 10% margins. And third, making every single rupee of capital work smarter. This is pretty much the playbook for how to thrive in a tough environment.
Now, on the other side of the coin, you've got Kailash Namkeen. They're taking a completely different approach. Their management is talking all about expanding B2C reach and focusing on branded products. So instead of just playing defense on costs, they see their path forward as playing offense, building a powerful brand that can connect directly with you, the consumer, and command a higher price.
Their plan is pretty much all about growth. They're trying to capture new markets by going directly to consumers, they're aligning with modern tastes for healthier options, and they're using digital channels to fuel their expansion. It's a really clear choice, brand-led growth versus operational efficiency.
So with these 2 competing strategies in mind, what does the bigger picture of threats and opportunities look like for the whole sector? Well, it's a landscape of immense potential, but as you might guess, also significant risk. The industry's strengths, in product innovation and quality, are constantly being tested by its core weaknesses. And these weaknesses are exactly what we saw in the data. That intense competition? Well, that's why those selling costs are skyrocketing. And that heavy, heavy dependency on raw material prices, that makes the entire industry really vulnerable to supply chain shocks.
And this just perfectly captures the tension between opportunity and threat. It's like a dual-edged sword. On one side, you have these massive opportunities with new markets opening up and the boom in e-commerce. But for every one of those positives, there's a potential negative lurking. Inflation, unpredictable demand, and that huge cultural shift towards healthier eating.
So, after all that, what should you take away from this? Let's try and distill this whole complex picture down to its most essential points. In short, this industry is really a story in 3 acts. Act 1, massive, undeniable growth. Act 2, a severe profitability squeeze caused by those rising costs. And Act 3, a strategic pivot, where companies now have to choose their path, either master efficiency or build an unshakable brand to survive. And this leaves us with one final thought to chew on. In a market that's defined by this constant tug of war between growth and cost, will simply creating new and exciting products be enough? Or will the real winners be the companies who master the less glamorous but absolutely crucial art of efficiency?